Johnny's a one-man gang, and Mike is letting Johnny have a space in the business free of charge, no rent, no utilities. Johnny doesn't have any indirect labor. It's just him, okay? So there's no direct overhead. At TAC, the overhead makes up a big chunk of our expense, okay? 36, 37%, no, 25%, about 25%, sorry, about 25% of our revenue goes to pay overhead. And those overhead items, even though we're doing a yo-yo business and we don't really have overhead, the overhead items at TAC, rent, utilities, DER fees, calibration, tech data, in non-direct personnel like Aaron Stacy, okay, Cody Wolf, people who are working and drawing a salary but not working a part that generates revenue, okay? So our standard cost per yo-yo, which is important to keep track of, is 97 cents. And that financial term that's used for that is the cost of goods sold, or the COGS, okay? And I'm going to share with you all something about financial people. And you don't work in finance, do you? I don't want to pick on you if you do. People who work and deal directly with finances, accountants, CFOs, they like to throw terminology to stay on top of the game, okay? And just when you think you've got the terminology figured out, they'll use another term for the same thing because they want to be smarter than you. And so that's one thing to keep in mind. We have really tried to be consistent with how we refer to these financial terms. If you start changing this and you go, well, our standard cost, you'll confuse people, okay? So I want you all to think about, as you're teaching this class or you're talking in conversation with our employees, try to use the same terminology that we use day to day or that we use weekly in our huddles. COGS, direct material. You know, like we don't call it material, we call it direct material, and we call it direct labor, okay? Use those same terms because otherwise people will get confused and they won't be able to tie the two together. If you say standard cost, you've lost 90% of our workforce, okay? Now, we got to get our business off the ground, and this is a very important piece to launching the business, okay? We need a sales plan. Hey, Brady, you like doing a sales plan every year? Brady spends months, and his team spends months building a sales plan, okay? And the reason why you need a sales plan is if you don't forecast your sales, you're going to have a hard time being prepared for them. Because remember, we asked ourselves back on the slides where we ask ourselves the question of how many are we going to sell? Well, if you don't know what that is, you're not going to have the right materials in stock. We're building yo-yos. Well, let's assume this is our 6-month sales plan for yo-yos, okay? And in month 1, we need to make 10 yo-yos. And we stock and we build the money necessary to go to month 2 based on month 2 going from 10 to 30, 30 to 60, 60 to 180, and so forth, okay? So as we're doing that, let's say between months 2 and 3, we get an order for 100. But in order to get that order for 100, we've got to ship all 160 in the 3rd month. What does that do to your business? Huh? It drives some stress. I mean, just think about putting a 4-inch pipe into a 1-inch hole, okay? And in order to do that, what happens to the business is it becomes very reactive. Start overnighting freight. Start paying people to work overtime or hire a bunch of people or both, okay? And that drives your cost because you weren't ready for it. All right? My course book gives an example about SRC, but none of us worked at SRC, so I'm not going to talk about SRC. No offense to them. They had their own financial struggles in the 80s. We had a business entity here called TAM. And one of the things that happened at TAM was we started absorbing manufacturing contracts, okay? And we ran an analysis on what our profitability for these manufacturing jobs would be, and it looked profitable. But what happened was, in order for us to deliver that work, we had to spend cash, lots of it. We had to go buy the raw materials, and if we didn't buy enough raw material to produce the whole contract at once, see you, Mr. Stacy. If we didn't buy the raw materials to produce all of it at once, then we would have to almost double our cost or triple our cost on what the piece of that raw material would be. So we went out and we spent all this cash to produce these contracts. And we had to pay cash for labor. But we couldn't collect any money until we finished 10 pieces, 15 pieces, and shipped those pieces. Okay? So a sales plan becomes very critical in order to determine what you need from a business standpoint to run the business. Mike, when we do our sales plan, Brady puts together a sales plan. What's the very next step?
We go from a sales plan to send it to all the other folks that go from the sales plan, and then you start coming up with expenses off that sales plan, and what it's going to take to produce that sales plan.
That's right.
How many people do you need? How much material? What's our direct material cost? What's going to happen there? And Tom wants to know what products is Brady bringing in, because i.e. winglets cost us a heck of a lot more money to repair those than it does a flat. So we got to know that kind of stuff.
That's right. So we budget. We go from a sales plan to a budget, and the sales plan becomes very critical. Well, Johnny's put together a sales plan for us, and over a 6-month period, he's going to sell 840 yo-yos. All right? And he's got a really aggressive ramp-up rate on production. Okay? So Johnny gets in and he goes, okay, I need to figure out what my startup capital is. And in order to determine that, I want you all to think about the definition of capital. Capital is the financial assets or the value of those assets needed to start the business and operate the business. And that can be cash, your facility, your space, your factory, okay, the machinery and equipment. Johnny doesn't have a whole lot of equipment. He's got a sander, okay? But at TAC, we had an oven, a paint booth, a blast cabinet, a brake, a shear, computers, okay, a forklift, a van. Those were all equipment purchases that were made to start the business. Okay, an air compressor. The factory wasn't just the building that we were paying for at 1483, it was also the renovation cost of adding electrical, the air lines, the vacuum lines. All those things went into starting up the business at TAC. So you've got to determine what your startup capital was or is. And Johnny, you know, Mike and Randy have decided we're going to give him a space in our building, but Johnny's got a little bit of money in his piggy bank. And he's determined that the startup capital that he needs is $30. Okay? I might have jumped ahead of myself a little bit. But Johnny needs $30, and he's got $10 in his piggy bank. And he's going to borrow $20 from his grandmother. His grandmother, she's not going to miss that $20, okay? And she wants Johnny to have a job. She thinks Johnny needs to start contributing around the house, okay? Like Brady thinks Taco should do. Taco needs to contribute around the house. All right? He does sit around the house all day. Well, when we talk about the balance sheet, we've looked at what our startup costs are, and we're going to focus on this piece of the financial statements called the balance sheet. All right? And I want you to think about the balance sheet as something real simple. All right? So what you own equals what you owe plus what is yours. And you know, Randy talked about being able to take this into your personal lives. That's a very simple assessment of how balanced you are in life. Okay? And so, in financial terms, that means your assets equal the liabilities plus the owner's equity. Okay? And
what's the difference between, why does it say, one's our assets, it says what you own,
Mhm.
and then owner's equity says what is yours? Wouldn't that be the same thing?
no. Because the assets equal your liabilities as well. And it's a balance of your liability and the equity that you have. And equity comes from,
So would my house be an asset or a owner's equity?
it depends on what your value of the house is versus what you owe on the house.
What you paid into it.
Okay?
House can be worth 100, but you may own 10 of that.
That's right.
So if you owe more than it's worth, it's a liability, but if you own less, then it's more of the equity.
That's right.
9 equals the 10 equals 100.
That's right.
Yeah.
Okay?
That's what happened when remember when the real estate market went down? There was a lot of liabilities out there because people owed more than what the house was worth.
Right? And in your financial statement of your balance sheet, your asset becomes the cash plus your inventory plus your equipment. Okay? You've got a starting cash balance that you carry over, and that's an asset. Plus you've got your inventory. Okay? And then you've got your tools, equipment, the bulk stuff falls into the inventory. All right, Tom, what's our inventory running? $2.4 million in inventory. Okay? And when we start a month, our cash, we might be at around $800,000 in cash, Mike? Roughly? Depends. Depends on where we were for the month. It could be lower. Okay? How many accounts we paid versus how many we received. But we take that cash balance plus our inventory plus the value of our tools and equipment out here. Okay? And those all have a book value. Okay? And that is how you come to your balance sheet. We're going to look at the balance sheet for month 1 of our yo-yo company. Okay? So month 1 of our yo-yo company, I told you we had $30 in cash. Johnny's 10, or I'm sorry, Johnny had 20 in his piggy bank and 10 that he got from his grandmother. Sorry about that. So Johnny's initial investment of $20 plus the $10 that he got from his grandmother, okay? He hasn't bought any inventory yet. So he's got a total asset of $30, and he's got a total liability and owner's equity of $30. $10 for his loan, $20 out of his piggy bank. Okay? Your balance sheet is balanced. Okay? It has to be that way. It has to equal. Now, our balance sheet here at TAC, it's a lot bigger than this. There's a lot of different pieces over here on this side, and there's a lot of different pieces over here, and it can be summed up into some smaller pieces, but if you expand it, you know, there's a lot of different lines in this balance sheet. Okay?
Why would you want it balanced though? Why wouldn't you want your assets to be higher than your liabilities?
Can't. It can't, because the whole fundamental of the balance sheet is that it's balanced. All right? Now,
Your biggest scorecard is telling you where you are in the business. So it's not trying to get the assets more than liabilities. It's just saying, this is where the money is, and this is what I.
yep. That's right. And it's not, this isn't this isn't going to tell you your value as of I've got this minus this to equal this. This is going to be a balance. It's going to show where your cash and inventory is, and then over here your liabilities and your equity. Now, keep in mind, your equity, your investment, and your liability here, that's over here. That's your cash. Okay? And so that's why it has to balance. Okay? Does that make sense?
Yeah, it kind of differs. The income statement is where you can kind of tell if you're winning or losing.
That's right. Your income statement's where you see profitability, and we'll get into that. Okay? We're going to talk about the income statement. So, we're in month 1, and Johnny has got to go buy some stuff. Okay? Now, Johnny goes and buys $20.64 worth of inventory. Johnny goes and buys $20.64 of inventory. He's got to build month 1. How many yo-yos did we say we were going to make in month 1? 10. And what was the material cost of a yo-yo?
97 cents.
So 97 cents. He's got to build 10 yo-yos. He needs some bulk materials. Okay? He needs a paintbrush. So he goes out and spends $1.50 for that tool. He can't paint his yo-yos without a tool. So he spends $1.50 on a paintbrush. Now, Cody, why does it balance is better illustrated here, okay? Because Johnny still has $30 in assets. On the previous slide, he had $30 in cash, no inventory and no tools. Okay? But he went out, he spent some money. He still has $30 in assets. He still owes Grandma $10. He hasn't paid Grandma any money yet. All right? He still has his initial investment of $20, so his equity is $20. He's in for 20 bucks. Okay? And if he sold his inventory over here, he'd get his $20 back. And his grandma's 10, because that 30 equals that 30. That's why they have to balance. Okay? All right. Now we get into what you all see every day or every week. An income statement. Okay? So, here's the good news. Johnny sold 10 yo-yos at $3 a piece. Okay? He made $30 in sales. All right? And his cost of goods sold for that was $9.70. Remember, we said that the cost to produce a yo-yo was 97 cents. Okay? So, Johnny had a cost of goods sold of $9.70. His gross profit margin was $20.30. Now, Johnny doesn't have a delivery driver. Okay? His dad agreed to take him around town and deliver the yo-yos for free to help get the business off the ground, so there was no expense there. Johnny doesn't have to pay rent to Mike and Randy because we're going to give him some space here for free. So he didn't have any expenses. So his profit before tax, which is what here at TAC? What do we call profit before tax here? Critical number. What's critical number for? Why do we say that's a critical number? It's what the bonus is based off of. And we call it a critical number because we've identified that the way that one of the best, or our key way of judging the business success is off of profit before tax. Okay? We can control our overhead and get above the line numbers to be high, But if we get into our expenses and we don't control those expenses, the business could lose money. So we drop down here to profit before tax, and that becomes basically our key performance indicator or our critical number in terms of the great game of business. The great game of business teaches that a company needs to identify what its critical number to financial success is. How does anybody in the company look at how we're doing and measure whether we're successful or not? Okay? Now, if we stopped here, and we have used gross profit before as a number, what do you think happens in your expenses if they go crazy? Nobody in the company has vision of that because you're not reporting that as a critical number. All right? And that's what can happen. It didn't really happen to us, but we did have a year where gross profit was our critical number. Okay? And turn time was the kicker. We had a really complicated year that year. Remember that, Mike? So we had a bonus based on your gross profit, and then we gave a little kicker on turn time. Okay? So everybody has to pay the government. Nobody gets away without paying the IRS their taxes, right? And in this example, I think they use 25%. Yep. Okay? TAC's current tax rate is about 34%. All right? Now, when you get here, businesses, Johnny's business paid a lot in taxes on $30 in sales, okay? That's a 25% take of his money so that Uncle Sam can do what they want with it, all right? Businesses, especially as they become larger, try to figure out ways to defer or get around this. There's expenses that you can take advantage of to offset some of this expense, all right? And that's where some financial people really make their way. So Johnny's first month comes out to a net profit of $15.23. Okay? Now, when you look at the income statement, I want you all to think and teach in terms of this is how you judge the profitability of the company. Okay? So what do we call this at TAC often? What do we refer to the income statement as at TAC often? P&L. And what does P&L mean? Profit and loss. Okay? So that's what this statement is, and I told you about financial people and how they try to use different terms. The name of the financial statement is an income statement, but it's often referred to as a profit and loss statement. And that's what we call it here at TAC more times than not. Okay? And one of the best ways to judge your profitability is by converting these numbers into percentages. Okay? And everybody thinks differently about numbers. Some companies take the sales, and where we report last month $2 million in sales, they might report it as 2.0. So they make that number smaller so that people can not have to look at so many zeros. Okay? It is what it is. I want you all to go in and calculate the profitability of Johnny's first month and turn these dollars into percentages. So what I'd like you all to do right now is I'd like you to, I don't know how many of you have calculators on your phones or how many of you have them out, but if you can get a calculator out handy, and if you don't, if you need one, I want you to go in and I want you to divide the gross profit dollars or the margin by sales. So divide $20.30 by $30. Somebody give me that percentage.
68.
So Johnny's first month carried a 68% gross profit. What do we normally look at here at TAC? 30s, mid-30s. Johnny did pretty good, right? Not bad. All of us would like to have a business that grosses 68%. Okay? In some markets, gross profits can be really, really thin. Okay? Now I want you to divide the profit before tax. Okay? Peanut butter and tangerines, PBT. I want you to divide that number, which is the same, so just carry your percentage down. Same percentage, right? All right. What do we normally run at TAC for profit before tax? That's a little tougher number for you all to throw at me.
8, 10.
It's about 12, 15. About 12, 15, depends. SG&A drives it up or down sometimes. Some of those exchange fees can take a hit on that, but it's about 12, 15. I think in the budget it's budgeted at 15%, if I'm not mistaken. Okay, for the whole of the year, Mike. You think that's pretty close?
Yeah, I'd say pretty close.
14, 15% for the budget. Now we drop down into net income. Johnny had to pay the IRS. Okay. A lot of times when we go here at TAC, the number really is profit before taxes and bonuses. Okay? Because we drop bonus in before taxes. Okay? So our number really is PBT and B, and we used to call it that. I think we simplified that, try to make it easier for everybody. All right? And in our big financial statement, when we look at our income statement here at TAC, there's a real key financial term that we're not using for Johnny's business, but a lot of companies and a lot of financial institutions look at what is called EBITDA. EBITDA is earnings before interest, taxes, depreciation, and amortization. And when you look at the value of a company, a lot of financial institutions use that EBITDA number in valuing a company or seeing what the profitability of a company is. Okay? Mike, our bank uses EBITDA quite a bit, right? So that's a real key number, and I think we've used EBITDA before as a critical number, if I'm not mistaken.
I think we did one time, I think we want to go back to profit before tax.
Yep. All right, so it's just harder to get people educated on what depreciation and amortization charges are. That's a very tough financial aspect to teach people, okay? So we come down to net income, and let's divide $15.23 by $30. And let's all applaud Johnny, because Johnny had a hell of a first month, okay? 51%. All right, so Johnny killed it, okay? And we're going to take a break now that we know that Johnny is popping a champagne bottle on his first month, and he had a 50% net income month. And Jason, you're 10%. That's generally what we're looking for in net income. Okay? That's what we budget as a good number for net income. Okay? Our balance sheet after month one showed us at $30 and $30, okay? Or before month one. Now we're going to look at our balance sheet for the end of month one. Let's back up here. We had some sales. We had some net income. Okay? So, let's go back to our balance sheet here. We had $7.86 in cash when we started the month after our first purchase. Now we've got $30.69 in cash. Carried some money over. We had to use up some of that inventory to make the yo-yos that we built. Remember we had, where's my direct material cost? Where'd my direct material costs go?
It's $20.64.
$20.64. I think it's on one of these. Yep. Where does it have your material? We sold 10 yo-yos at 97 cents worth of cost of goods sold. We ate up some inventory. We still have our $1.50 paintbrush. Johnny cleaned out his paintbrush with a little bit of mineral oil, and he's rolling on, okay? Now, he still owes Grandma $10. Okay? Now, over here, his earnings so far is his net income. You see your net income here? $15.23. And you see that net income carry over to your earnings. Okay? And so your earnings add to your initial investment of $20. So your total owner's equity now is $35.23. Plus the loan that you owe and your liability. So your total liability and owner's equity is $45.23. The cash that you carried over was your sales minus your cost, okay? Plus the inventory adjustment. You used some of the inventory that you had started the month with. Back here you started the month with $20.64. You made 10 yo-yos, so you consumed some inventory. So our balance sheet is balanced, which is great. And not only is it balanced, from the start of month one to the end of month one, our balance sheet grew from $30 to $45.23. Okay? Does that make sense to everybody? Now, what I'm going to do at this point is I'm going to let you all, on your own, go through the workbook on your own time. Bless you, again. On your own time in a situation where you're comfortable doing it. But I'm not going to let you off the hook. If I don't get a sheet back from you or sheets back from you, I'm going to come hunt you down and I'm going to take your birthday away from you. Okay? That's how serious this stuff is. You're going to go through and you're going to look at the example given for the month 2 income statement, the month 2 balance sheet. All right? In month 2, I want you guys to know that Johnny pays back his grandma. Okay? I want to point that out to you all. In month 2, he's going to pay back grandma because grandma told him she was going to break his fingers if he didn't come off that $10 that he owed her. Okay? She's hardcore.
She looks hardcore.
Look at her. She looks like Grandma Holbeck. Okay? The next thing you're going to work on is you're going to work on the cash flow statement. We've gone through month 1, and I want to do the cash flow statement with you all because I want to cover all 3 financial statements with you. And this is a very important piece of the financial statements and how the bank looks at your company. Okay? So let's slide over to whatever page the cash flow is on. 17. And according to the page you have in your book, I wasn't lying. The cash flow statement is one of the most crucial financial statements in the business. Okay? Drop that off. So we started up the business, we had $30 in cash. All right, now the cash flow statement is basically split with inflows and outflows. Okay? Jeremy and Cody and Mike, Brady, you guys have seen, Brady's not here, you guys have seen our cash flow forecast that we do. Okay? I take you guys and I show you our cash flow, right? We do a rolling forecast on cash, and then we look at the actuals. So you've seen a cash flow statement. And we show you the money coming in, right? What was paid, and we show you what goes out. It's real simple as far as the structure of this is concerned, okay? But we started the month with $30, and we had sales of $30. So that gave us $60 in the bank net, okay? But to get to this $30 of sales, we had $20.64 of materials that we bought and paid for, right? We had to pay labor $2.10, that 21 cents a yo-yo, 10 yo-yos that we made. So we spent $2.10. What's this capital? What's this tool? The paintbrush, $1.50 for the paintbrush that we needed, okay? We didn't pay any loans. Luckily, Johnny doesn't have to pay interest either. If this were TAC, we would have a minimum interest payment to make right here. Banks aren't going to let you get away with not paying them, okay? So we have loans, you draw a loan, you've got to make that interest payment. No different than in your personal life. If you draw on a credit card, they send you a bill and says, this is your minimum amount due, okay? No different. Man? I know, I like grandma. Johnny had to pay taxes of $5.07. So his total outflow was $29.31. And what that left Johnny was $30.69 in cash. $39.69. So I wanted to tie that all together for you all so that you could see where that $30.69 came from. Okay? That was his cash to start the month, number 2. Okay? So, that $30.69, he's got to go make 20 yo-yos in month 2. Okay? So in month 2, he goes and makes that inventory purchase. His inventory went up from $13.04 to $32.84 because he's got to make 20 yo-yos. He's got to go buy the inventory to do that. Okay? Still keeps his paintbrush. Still owes his grandma. And that's how the $45.23 shakes out after he makes his month 2 inventory purchase. Then we get into the income statement for month 2. He sold 30 yo-yos at $3 a piece. So he had $90 in sales. The cost of sales, or cost of goods sold, was $29.10. And his gross profit margin was $60.90. And the way that you get that is you subtract your sales, you subtract the cost of goods sold from the sales. Okay? Johnny still didn't have to pay rent, utilities, insurance. So his profit before tax comes down $60.90. Somebody give me the percentage of profit before tax to sales. What was Johnny's profitability in a percentage?
66.
Remember to do that. You divide the profit before tax by sales. What was it? 68%. That's really strong. And then he had to pay his 25% tax rate. And so his net income is $45.67. Okay? Hopefully, at this point, you all have an understanding of the 3 financial statements, and you're going to go play the game in months 3 and 4 on paper by yourselves. Okay? And what I want you to do is, Jennifer, do we have instructor guides?
No, we don't have extra ones.
Okay. What I will do is come see me, and I will let you make a copy of my instructor guide. Or I can give this to Jennifer, or Jennifer can get you all.
Copies, yeah.
Jennifer will get you all a copy of this so that you can check your own work once you're done filling in months 3 and 4. But before I move on, I want to ask, do any of you have questions? Because again, the goal of this is so that you all can go out there and teach the yo-yo game. And I understand that I did a very abbreviated version of this, but I also tried to focus on more of the applicability to Texas Air Composites and less of really running your own yo-yo company.
That's the thing I get out of it, that when you start your first balance sheet, you get $30 cash.
Yep.
After you start your second month, you get like $30.69. So you've done a lot of gyrations, but it's not like your cash hasn't gone like this. It's kind of stayed there because you can operate the business.
Sure. Sure. And I do think that financial institutions look at the growth of your balance sheet as a measure on the company. And they could look at really aggressive growth on the balance sheet different ways. But they certainly look at the growth of the balance sheet, that $30 to $30.69 growth to $45. Banks and lending institutions, and especially if you're selling your business, people are going to be looking at your balance sheet closely. And that's one of the things they're going to look at, is that month on month, how you're doing with growing your balance sheet. Okay? Mike, I don't know how much we really, the banks really spend looking at the financial piece of the balance sheet with us, but I know that if we were to start looking at the pieces of it individually, they probably spend a lot of time in there. Like, they look at the inventory a lot. Okay? And they look at the cash a lot. Yeah. And that's the basic, that's your basic elements. Okay? And tools and equipment. Now, TAC, we have spent a lot on tools, but then you get into the complex amortization, depreciation cycles, and all of that starts coming into play. And that is a lot more complex, as you start running into setting the useful life of a tool and you name it. And what dollar amount do you actually capitalize versus expense? I think we use $500, is that right, Mike? So there's different pieces of that. When do you say I'm going to pay for this in my financial statements over a period of its useful life versus I'm just going to take the expense of buying this piece of equipment or this tool and pay for it right now in the income statement? Okay? Anybody have questions for me? I'll be more than happy to dig into these a little deeper with you on a one-on-one basis. Really what I want to do is get you all back into the flow of the company, but the workbooks are very detailed, and they give you a lot of direction on how to fill things out. In fact, I think they give you the answers in the workbook if you just flip pages. Okay? So there's some important things to remember. Number one, your cost to make a yo-yo is 97 cents a yo-yo. Okay? Number two, your balance sheet should be balanced. If it's not balanced, then you have a problem. You need to go back and double check your numbers. Okay? And number three, cash is king. You'll see that when you go through these exercises. If you don't have the cash, you can't keep producing parts. You wouldn't have the money to buy the inventory or pay for the labor. All right, so you all, please fill in from pages 19 on the different tables and you're going to become Mr. Business Owner, and you're going to follow through months 3 and 4 on your own.
Is that 19, 20?
Yep, 19 and 20. And don't cheat. The answers are in here, but go through it and try to figure it out without having to cheat. Okay? And I would encourage you that practice does make perfect. It says that in here, but I really want you to take the time to run through some of these scenarios. I think what will happen is if you all get tasked with teaching a small group of people the yo-yo game, you'll probably do what I did, which was I went home and sat down with the girls, and we did the yo-yo game at home. Okay? And that's the best way for you to learn how to teach, is to practice. And if you know how to teach, your understanding of it will help you more in the business side of it that we do day to day. TAC, and we're going to have some fun and do the stuff that I like to do more, which is not look at paper and mess around with a calculator so much, but we're going to build some yo-yos, okay? And we're going to talk about the day-to-day at TAC, because all of you might end up with a different scenario. Yeah. Everybody gets one. And hopefully I got enough. Here we go. How many more do we need? Mike, you got one?
I do not have one.
Here we go. All right, don't be afraid to open them. I want you all to open your business kit. All right? All of you get one of these sheets. And I just sold you all a storefront, okay? Brady, you gonna make your... So you all see the cost of each piece in that middle of your page that I just handed you. All right? And what I'd like you to do is, do those come with instructions? They don't have any instructions, do they? Okay? So it leads you to have to figure out how to do this on your own. But what I want you to do is I want you to start by getting all your pieces out on the workbench. Okay? And I want you to think through what you're going to do with your yo-yo for a minute. And I will tell you that your dowel rod needs glue on both sides.
Got instructions on that.
All right. Sweet. See, Nick is smart. Handy like a pocket on a t-shirt. All right. Now, Cody, I want you to stop. Stop right now. Jason, you need to stop. Okay? Okay, now you guys can keep going. Huh? Oh, here you go. It'll stop on its own, but... All right. Sorry about that, Shemaiah. All right. I want you to build your yo-yos. All right, Nick, I want you to get on your sheet, okay? And in your cost of goods sold line, instead of, let's get my cost per yo-yo slide up here. I want you to get your pen out. And because, Nick, you don't make $4.20 an hour.
One of these days,
Nick, you make $6.44 an hour. So I want you to calculate at $6.44 per hour, okay? Now, the time, thank you, Shemaiah, the time is 1:09. And we're going to measure how long it takes you to build it. Cody, I'm going to sell you this piece of string because when we did your yo-yo, inspection didn't requisition your string. Okay? But I've got to overnight your string in here because you really need this to finish it on time. And instead of your string costing, where's my cost? I need a driver. Instead of your string costing 2 cents, it's going to cost you 8 cents. So your total material cost is going to go up to 72 cents. Okay? And Jason, your wooden block has a gouge in it. Okay? And it was hidden damage. You just got an add-on for a gouge. And I need you to tell me how long that's going to take you to fix your gouge.